Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, June 5th, and the market's favorite shiny object, artificial intelligence, has walked into Washington wearing a tie and carrying a compliance folder.
Which is terrifying because nothing says explosive innovation like a folder labeled, "Please review before launch." But for investors, this is the real story. AI is still exciting, but now it comes with politics, export controls, IPO timing, and one tiny question. Who actually gets paid?
Story 1. CNBC reports that Senator Elizabeth Warren is pressing Nvidia CEO Jensen Huang to appear at a Senate hearing on China AI chip sales, export controls, Trump, and data center policy. Translation, Nvidia is not just a chip company anymore. It is practically economic infrastructure with a ticker symbol.
It is basically like selling the world's fastest sports car, then discovering every government wants to inspect the engine, the road, the driver, and maybe your playlist. Investors love Nvidia's AI demand, but China restrictions can change revenue assumptions faster than I abandon a budgeting spreadsheet.
Here is the simple finance version. When a company trades on future growth, anything that affects access to major customers can move valuation multiples. Export controls do not need to kill demand. They only need to make the path less certain. And uncertainty is the market's least favorite seasoning.
I slightly disagree. Uncertainty is annoying, yes, but regulation can also protect incumbents. If compliance becomes expensive, smaller chip rivals may need a lawyer, a lobbyist, and a therapist before they ship anything. Nvidia might grumble publicly while privately saying, "Thank you for the moat."
Fair pushback. Story 2. OpenAI says it will comply with Trump's order requiring AI model reviews before release. OpenAI's head of countries, George Osborne, told CNBC that governments have a big role to play in how this technology is used and deployed.
That quote is doing a lot of work. For normal people, model reviews could mean safer tools, slower product releases, or both. Imagine your phone getting smarter, but before every upgrade, it has to pass a driving test, a dental exam, and a group chat with regulators.
For finance, this matters because AI valuations assume rapid deployment. If release cycles slow, revenue timing changes. If reviews build trust, adoption can broaden. That is the investor puzzle. Is regulation a speed bump, or is it the bridge that lets cautious enterprises finally spend real money?
And then there is Anthropic. Channel News Asia reports that tensions between the White House and the blacklisted AI company are easing ahead of a potential IPO, according to sources. That is a very Wall Street sentence. First, you are in trouble, then suddenly everyone remembers there may be fees.
Exactly. IPO investors care about revenue, margins, and growth, but also headline risk. If political tension eases, the IPO story becomes cleaner. If it returns, public investors may demand a discount. In personal finance terms, never confuse a hot narrative with a risk-free asset.
Story 3 gives us a non-AI oxygen break. Bloomberg reports Philippine inflation unexpectedly decelerated last month as transport cost pressures eased, helped by fuel price rollbacks. The central bank says it will take necessary actions to return inflation to target.
This matters for households immediately. Transport costs feed into commuting, delivery, groceries, and business margins. When fuel pressure eases, consumers may feel a little room in monthly budgets. It is not a lottery win. It is more like finding $20 in a winter coat.
And central banks love that coat money. Lower inflation can give policymakers flexibility, but they still have to watch currency pressure, oil shocks, and global rates. So do not hear slower inflation and immediately sprint into debt like your credit card is offering emotional support.
Final story. SCMP reports UBS estimates Chinese companies raised about 43 billion US dollars through equity capital market transactions in Hong Kong in the first 5 months of 2026, up from 28 billion a year earlier. Foreign investors are returning through IPOs and convertible bonds.
That is not pocket change. That is serious global capital sniffing around AI, semiconductors, and advanced manufacturing. Convertibles are especially interesting because they are part bond, part stock option, and part financial smoothie. You drink it hoping it contains upside, not hidden risk calories.
So today's recap. Nvidia shows AI investing now includes geopolitics. OpenAI and Anthropic show regulation can reshape timelines and valuations. Philippine inflation reminds us real-world costs still drive wallets. And Hong Kong's fundraising rebound shows investors are selective, not asleep.
Action step. If you own AI-heavy funds, check concentration risk. If you follow IPOs, read the regulatory section before the hype section. And if your budget is fuel-sensitive, use any inflation relief to rebuild cash buffers, not to upgrade your lifestyle into a subscription-based panic room.
That is BD Daily Finance News Podcast. Subscribe for clear, lively finance briefings. And tell us in the comments, is AI regulation a threat to growth or the moat that makes the winner stronger?
And please like the episode if it helped. It tells the algorithm we are responsible adults, which is hilarious because I just called convertible bonds a smoothie. See you next time.